Welcome back. So we look at the Nigerian banking sector. Now, the performance of Nigerian equities so far in the year, has been driven by sterling performance of the banking sector, which has returned over 60% year to date compared to 37% of the broader equities. Nigerian banks have remained fundamentally strong in terms of earnings and capital adequacy, although also asset quality issues that have pressured earnings and elevated risk considerations for the sector. So let's talk more about this with the head of research at AfriInvest, Robert Omotunde. Good morning, Robert. Thank you very much for having you on the program.
Thank you, Chimese. Good morning.
So how would you describe the resilience of the banking sector in Nigeria, especially in the light of the recent development in the economy?
Well, thank you once again, Chimese, for having me. You recall that since we had the fall in global oil prices in 2014, the economy has been challenged, and the banking sector was not really spared from those challenges. We saw that in 2015 and 2016, a lot of these banks had issues. We even had issues of banks having to lay off their staff. But amidst all of these, we saw a resilient bank, especially, when you look at the performance of most of these banks in 2016, even though we had high non-performing loans issues that the industry was kind of facing, we still saw that banks were able to churn out very positive earnings, even though we had a devaluation following the liberalization of the foreign exchange market, especially when the CBN announced it in June 2016. We saw the banks turning this into very positive results, especially when we look at the banks in terms of their gross earnings and, of course, profitability. We saw a couple of banks who were able to do above 100 billion profit after tax in 2016. And this resilience has been taken even into the current year, when we've seen recent recovery because of, the respite that the economy had gotten. The economy is coming out of the woods, and the banks are also coming out stronger.
Now, what factors do you think have majorly driven, the earnings of these banks, particularly from the core interest earnings?
Okay, in 2016, when we saw most of the banks churning out very positive numbers, one of the facts that we noted after analyzing the earnings was that most of them had foreign currency denominated assets, and with foreign currency denominated assets following the devaluation, which we saw, which was up to 50%, the implication of that is that they had more earnings, especially from core, interest income earnings. And of course, it was somewhat around when we saw that devaluation of the currency that the Monetary Policy Committee also raised interest rates. Market rates have been pretty much up. We've seen most of the banks playing within the treasury bills end of the market. Even some of them are still doing bonds, even though it's not as active. And the implication of that was that we saw most of the banks turning out very positive numbers, although that had implication on the rate at which they were growing risk assets, of course. But again, the banks are in business to make money. And so I can say that the high interest rate environment, coupled with the devaluation that we saw in 2016, actually drove the earnings of most of these banks.
So what are the prospects for future earnings given the interest rate environment?
Okay, so what we've seen recently, especially from the last Monetary Policy Committee, we've seen that the committee is beginning to guide towards a possible reduction in rates, and market rates are even started to trend downward, given the last recently conducted OMO auctions and even treasury bills and bonds auction. So this implies that the high interest rate environment is beginning to moderate. But what we've seen most of the banks also trying to do is to position, ahead of that. Some of them are locking in the interest rate. Some of them are also trying to consider the bonds market and see how they can lock in some of the fantastic yield that you still have at this moment, even though they are also trending downward. But nevertheless, we think that it's going to be a little challenging for the banks, who have been used to the the easy money, so to speak, in the event where you do not have to bother so much about the risk when you create the risk asset. So the banks were more or less comfortable with high yield of about 18%, which they were getting from the money market. If you compare that to the yield on loans, or pretty much the lending rate, you've seen that prime lending rate is about 17.8%, on the average. And this is where most of the loan book of the banks, generate their earnings from, because the maximum lending rate is for the retail segment of the market, where the banks are not so heavy. Because if you dissect their loan book, you'll see that most of these banks have up to 80%, even 90% of their loan book tilted more towards corporate. So prime lending rate more or less applies to them more. So we are going to see more of the banks trying to see how they can take advantage of the prime lending window available for them now that interest rates are beginning to trend downwards.
So are the banks likely going to perhaps start lending to the real sectors, or they have some kind of inherent risks to it?
Well, of course, there are risks to creating. That's why we call it risk asset in the first place. So when you create loans, you are creating risk assets, And if you recall, you will see that in 2016, most of the issues that we had that bedeviled the sector were from very prone sectors that were very prone to the economic challenges that we had at this time: general commerce, manufacturing, oil and gas, of course, the power sector. So we saw most of the loan books of the bank being challenged from these areas, and impairment charges, was high for the banks. On the average, industry loan book is still about 15%. Though it is claimed that if you remove the outlier banks, the likes of Diamond, FBNH, the Diamond, FBNH, and pretty much ETI, that's EcoBank, who have above 10% non-performing loans, the industry loan book is still about 8%. So pretty much there are challenges when you create risk asset. We think that the banks are still going to be able to assess their risk in the light of their business model and what they are looking at, especially now that interest rate environments are crashing. The banks cannot keep the cash. They still have to invest the money. So I think it will be much more of the banks trying to assess which risk they want to go into, and more like taking calculated risk, in playing the sector.